So a lot of people are relying on the S&P 500 to fuel their retirement, but people really don't have context for just how big the S&P 500 really is. So here's a quick little stat for you. Basically, if you add up all the revenue in the S&P 500 companies, and then you multiply that by 71%, because 71% of the revenue is generated in the US versus overseas countries, that number, it's a little over $11 trillion. That number is about 40% of gross domestic income for the entire United States. These companies make up such a huge portion of our lives and our day-to-day purchases, our salaries, et cetera, political influence, to say the least on that. These companies are massive, and the growth in the stock market has predominantly been due to an increase in corporate earnings over time, because the price to earnings ratio, right, the price of the earnings, essentially the valuation of the company, price to earnings ratio has basically been flat over time, going back over 100 years if you normalize for things like recessions. So the biggest driver in the stock market going up is just the S&P 500 companies getting more profitable. How do they get more profitable? Well, really, they increase their sales and they hope that their, costs increase at the same rate or less in order to have the total value of their profits go up. So when you're thinking about, how the stock market is going to perform in the future, the S&P 500 being representative of the US stock market, it's really a question of, is the American economy going to be bigger or smaller? And a lot of people, they get really in the weeds trying to make a quick buck, news releases, all these things, right? Trying to take, advantage of short-term differences, and that's completely fine. But the reason why the long-term investor, is able to perform so well on such little information and such little attention and such little skill and such little luck, the reason why is simply because the U.S. economy has been expanding due to increases in the population, increases in the amount of actual people in the labor force, as well as technological innovation, making things more efficient, making people more productive. So when you're thinking about the long-term performance of the stock market, it's really actually pretty simple. You just need to look at the economy. At least that's my opinion. But it's hard to see it any other way when 40% of the gross domestic income for the entire country is the S&P 500. So anyway, those are just some thoughts. It is interesting, aging population, our, national debt is going up quite a bit. These sorts of things, in theory, are going to weigh on economic growth in the future. They might, flatten equity returns. A lot of people think that. Vanguard thinks that. BlackRock thinks that. In the past, it's been about 7% compound annual growth rate for the S&P 500. Maybe if you looked at it more recently, with the recent increase in the prices, it might be closer to 8 or 9. But in general, people say it's about 7. In the future, these big guys like BlackRock, Vanguard, they're expecting it to be like 5.5, right? And I think it's really because of those big macro factors that we've been talking about. But anyway, so these are just some thoughts. I think it's an interesting stat, just to keep in the back of your mind, 40%. That's crazy. So figured I'd share it with you guys. Anyway, catch you in the next one. Like and subscribe.